Hello and welcome to a brand new show of Market Makers. Yes, we are back after a break. FY19 has started, lot has changed for global financial markets in this year, but the resilience what Indian markets have exhibited of late has been extraordinary. Bond yields have gone higher, there has been a bank scam, crude prices at $75, but markets are not far away from an all-time high. So what explains the underlying strength? Where do we go from here? Where should one put money to work? And after the sell-off in mid-cap stocks, are there bargains available here? So we'll start with the bank. So I have Nilesh Shah of Envision with me, and I've always maintained that Nilesh is not only a very old and a dear friend, he's one of the classic value investors I have met and interviewed, and I would certainly say, if not the best, he's one of the best. Nilesh, welcome to the show.
Thank you so much, Nikunj, and congratulations to you and the entire team for having such a wonderful office.
Thank you very much. So, got to start with first the market positioning. Whatever could go wrong has gone wrong this year. Interest rates have gone higher, crude is up for 20% this year. Markets are confused about which way interest rates would move locally and globally, and yet markets are not far away from an all-time high.
Yes, clearly I think the macros are not as great as what we have been used to for the last 3 to 4 years. But our belief is that the current headwinds that the macros are facing are just transient. It's not something which is going to last for too long, especially things like crude oil and other commodities. We clearly have a belief that they're unlikely to remain at such elevated levels. So what we think is that the macros have tremendous scope for improvement. But what the markets are probably factoring in right now is basically the improvement in our growth rates. Clearly believe that the GDP is all set to accelerate going forward and corporate earnings will even accelerate even at a much faster pace. And that perhaps explains why the market still continues to kind of trade closer to the all-time highs and are not significantly corrected.
Nilesh, every year when we start the financial year, we start with an underlying assumption that ये साल different होगा, earnings would be in double digit, and this time around also it's no different. The Morgan Stanley estimates for FY19 are that we will not see an acceleration, but we will see a huge acceleration in the aggregate numbers, and the number is about 15 to 17%. Is that a realistic number, or this time around again the optimists will get it wrong?
Well, 15 to 17% I think is a realistic number. I wouldn't be surprised if 15% ends up being a base case scenario. And there are a few reasons for that. First of all, earnings are strongly correlated to a stronger dollar and to a stronger crude oil. And assuming that this situation lasts for a quarter or two, we can expect a pretty strong first half. Number two is that the base effect itself is low. FY17 was one of the most tepid years from an earnings point of view. So the base itself is low. Third, FY19 is going to be the first year of full implementation of GST. So all the benefits of the implementation of GST and some bit of the hit which demonetization had, you will really see those that pain or the losses getting recouped. And fourth, I think the public investment in infrastructure is going to pick up pretty strong momentum. I think just one data point that if road construction activity, we end the last financial year at 24 kilometers of road construction a day, and the aspiration for next year is 45 kilometers a day. What it does to the core sectors, the core economy, I think is significant. So I'd probably say that because of these 3-4 reasons makes us very sanguine on a double-digit earnings growth for FY19.
So what does that mean for the Nifty? Do you think we have the top and also the bottom in place? Because there is good news and there is bad news. 2017 in a sense has spoilt us because we got a linear move. And 2018 has been full of volatility. And depending on whom you're asking, you're getting a different market interpretation.
Well, it looks like that the bottom is in place for the Nifty. Okay, it's quite possible that we may again, because of global events, we could again kind of break 10,000 and go on to retest a number below 10,000. But I don't think it's going to be substantially below 10,000. You could have 200, 300 points away from 10,000, and that's where I would think the bottom would be in place. I surely don't think that the top is in place. The best is yet to come for the Nifty. The best is yet to come for the markets. And that's going to be powered by a solid earnings growth, which we have not seen for the last 7 or 8 years. It's been almost a decade that we've not stepped into a double-digit earnings growth. And that's where I think the tailwinds for the markets are going to come from. So our sense is that we're going to see substantially higher levels for the Nifty maybe in the next 12 to 18 months.
What are the 2-3 factors you would look at when you are looking at buying into IT stocks?
Well, I think the first thing that you need to really look at in the case of IT stock is what is the segment that they are really focused on. That I think is very, very important. Are they into the conventional, traditional stuff, or they basically are into the new age businesses? I mean, of course, digital was new age 2 years back. Today, today digital is basically the mainstay of companies. But I think within that, there are different segments so I think one is to really say, what is the vertical, what is the domain, what is the business segment that this specific company is focusing on. So that's, I think, one. And the second important part of it basically is that, does this company have any kind of pricing power? Is it able to kind of get a better bang for the buck? Is it kind of able to get better dollars for every hour that any of its employees spends? Or is it kind of going more towards automation and things of that kind, which will improve productivity and therefore realize? So I think that's the second thing that goes. And third, of course, is that, is this company spending money on acquisitions, or is this company spending money on buybacks? I think acquisitions have not necessarily worked for IT companies. I mean, I think that's the big difference between TCS and Infosys today. That TCS actually spend a lot of money on buybacks, Infosys spend a lot of money on acquisitions under the erstwhile CEO.
Even Wipro, the string of pearls. Every 6 months they were acquiring a company.
So I think the street is telling us that look at the price performance of TCS versus the price performance of Infosys and Wipro. And I think the same applies for mid-cap companies. I think you have to be very careful when a mid-cap company goes out and does some acquisition. I think that should itself be the starting point of a question mark.
So you will not buy a mid-cap company when they're acquiring companies?
I wouldn't say I wouldn't bond, but I would be very careful of the price that they're paying. Is this kind of complementary or not? And is it kind of stretching is the balance sheet going to get stretched because of this acquisition or not? So I'd be very, very cagey and very, if a mid-cap company just goes and does an acquisition for the sake of doing an acquisition.
Which could be the next Tata Elxsi for Nilesh Shah and Envision?
Well, tough, but I think, we've been owning Persistent for some time now, okay? Obviously, over the last 5 years, the first couple of years turned out to be very good. The last 2 or 3 years have not been very good. But we clearly believe that the worst is behind for Persistent. We clearly believe that. We saw the digital revenues growing at 30%, and we think that it's probably today the most reasonably priced mid-cap IT companies. I mean, a lot of IT companies have kind of gone through the roof, whereas Persistent is honestly there where it was. And we clearly think that from a pure stock price, it has a reasonable upside potential.
What should one expect in terms of returns from the classics now? HUL, Titan, I can throw in an Avenue Supermart. These are good businesses run by efficient managers. But P multiples are something which at least I have not seen in my career, which is not a very big career.
Right.
But in my 15, 17-year-old career, P multiple of 70, 80, even 90 times for stocks like Avenue Supermart.
Yeah. Yeah, so I think, the valuations are crazy, like what you rightly pointed out. At these valuations, I'm not quite sure if there are returns to be significant.
Who's buying these stocks, Nilesh?
I think institutional investors who are benchmark, who run ETFs, or who have large pools of capital to be deployed, and you just kind of deploy it saying that, okay, fine, if India grows at a particular X rate, then an HUL or a Titan will surely at least grow at that rate, which I think should be satisfactory for them. I mean, if you kind of take a situation where the economy grows at 8% in real terms, at 5% inflation, so if they can kind of look at companies which are growing at north of 10%, I think it satisfies them from a purely ability to deploy large pools of capital. So I think that's really the segment which is basically. I think for investors who are looking out for bottom-up returns going forward, clearly I think consumer staples is not a great place to be in, especially given where the valuations are and where now they're dealing with saturated markets. I think the markets for soap, shampoos, etc. are reasonably mature. These are reasonably saturated.
Mature businesses.
These are mature businesses. But kind of look aside, and I think if we're talking of in India growing at a fast pace, if we're talking of an aspirational India, a middle class which is burgeoning, my sense is consumer discretionary is the place to be, and I think that's clearly where the big opportunity is. And therefore,
define consumer discretionary.
So, for example, where you don't need to consume it on a day-on-day basis, but where you probably consume it, say once in a year, or once in 3-4 years, or 5 years. So, obviously, of course, say consumer appliances is one area, but valuations are a little heady there. But the other big area that we see is travel, tourism, hospitality. I think the way Indians are holidaying, the way Indian families want to kind of holiday more regularly, more frequently, I think just increases the size of this industry and the potential. And there are very few quality players in this segment. And I think there's a huge scope for those quality players to get significantly re-rated over the next 3 to 5 years. So
there are two listed companies I can think of, Cox & Kings and Thomas Cook. The challenge for them, Nilesh, could be that they are not businesses which are monopoly in nature.
Right.
There is no moat around them.
Yes.
I can go on a website and perhaps get lured by another, another website which is giving me a better returns.
Right.
You're a classic investor. You like to buy monopolies.
Sure.
It may not be consumer monopolies, but it could be talent monopoly. It could be a service monopoly.
Yes.
What is the monopoly for some of these companies?
I think, see, at the same time, when I think a lot of Indian families yet, okay, still are stuck to the offline model. Okay, I mean, online will gain momentum, but yes, this will gain momentum many years down the line. And these kind of companies are also creating an online presence. It's not that they're not into online. So, but I think when an Indian family plans, including myself, when we plan a holiday, we don't necessarily do everything online. Okay, we probably look at airfares online. We look at the cost of hotel stay online, but then there's everything else. The local stuff out there, the destination management out there. We need to do a lot of stuff at those specific destinations, and that's really where the big margins are. Okay, so that's one, I would say, a market imperfection or a market inefficiency which is still there in this business. And even if this industry grows at 15-20% and these kind of companies being market leaders can sustain that kind of a growth rate, I think it is fantastic. I think the kind of cash flow generation which can happen, I think can be phenomenal. And the valuations at which they're trading at, I still think there's a lot of upside left.
When you buy a stock, what are the three things you look at?
Well, I think the first thing to really look for is basically the size of the opportunity that this company is addressing. Okay. So is the runway long enough for this company? Okay, which means that can you really see this company growing for the next 5 years and maybe even beyond? I think that's one important thing, and therefore it boils down to basically what is the growth potential for this company. Number two is that with this growth, will it be able to generate cash flows? Will it remain a capital efficient company, and therefore will it be able to generate a return on equity or a return on capital above at least a basic threshold level?
What is your benchmark?
I think broadly we be comfortable with the mid-teens kind of a number. We're saying is if a company can kind of grow in mid-teens, and if it can kind of generate a return on capital of at least a mid-teens kind of a range, then obviously that's a useful starting point. We're not saying therefore any company which, for example, has a particular mid-teen ROE, you go and invest in it, but these are all starting, I would say, filters out there. So that's basically the second thing. And the third, of course, is that does this have exemplary leadership? We've figured out over a period of time, and that's been our learning experience, that leadership makes a very, very big difference even in a vanilla business. And we've seen this in, say, for example, private sector banking or banking in general, private versus PSUs, and within private, we've seen it, how leadership makes a very big difference. So I clearly think that I'd probably say that these are the three important filters that one would want to kind of look out for.
The second checklist which I want to bring out is that how do you identify a good promoter versus bad promoter? Since you're insisting on leadership,
right,
I'm going to switch leadership to promoter.
Yes. So I think there are some very useful checklist points out there, some of the boxes which need to be kind of ticked. And we've been using something called the vices, that the promoters or the managements need to have the right vices, which is vision, integrity, competence, energy, and skin in the game. These are the 5 parameters, qualitative, that we look for. So obviously the management needs to be aspirational, it needs to be driven, it needs to be hungry for growth, there needs to be fire in the belly. So that's one. 2 is, does it have skin in the game? We've seen it that how earlier on companies with low management ownership. So Satyam was a classic case. I mean 10-15% ownership versus where managements have skin in the game. I think that's very important. And third, of course, is that what is the kind of balance this management is willing to kind of have between growth, cash flows, and the quality of its balance sheet. I think that balance is very, very important. And does the management understand this, or is it just kind of a one-way street which is just getting driven by growth and sacrificing the balance sheet and cash flows in the process? So when you only have growth and don't have everything else, what the investor sees is nothing but an optical illusion. And an optical illusion invariably ends up in a disaster. And we've seen this with many sunrise sectors. Okay, look at wind power, look at education. These are some of the sectors.
The boom and the bust stories.
Absolutely.
Okay. The next question which I want to put out, and that will again come up on your screen, is that do you buy a good business at a reasonable price or a bad business at a great price? This is a classic conundrum, I guess, every investor debates.
So ideally, never buy a bad business.
Okay.
Ideally, never buy a bad business. That's our philosophy. That's our style. Because anything bad will not have the good consequences or the good outcome for you. So I think always and always avoid a bad business, irrespective of the price at which it is available at. Okay. But you need to make, and therefore we'd prefer to buy a good business at a reasonable price. And that's really our investment style, that's our investing philosophy. But I think if there's a bad sector, okay, or a sector which is going through some really difficult times, but within that if you have a quality player or a shining star out there, then obviously you should obviously be cognizant of that opportunity available. So bad sector, bad company, avoid. But bad sector, good company, I think be constructive.
Buffett once says that buy good businesses when they go through a cyclical downturn, and that's your investment philosophy also.
Yes.
You know, businesses can go up and down, and that's where you have to bet on the potential of the management to identify it. Give me one, two, if not two, if not three, maybe two businesses which currently are going through a cyclical downturn. Markets are rubbishing them, and in a year's time, in 2 years' time, they will flourish again.
So I think in this context, I'd probably say that, make a distinction between a B2B and a B2C business. Okay, I think B2B business typically you buy at the business side when the business cycle is down. B2C I think is you should buy when markets are down. Okay, because typically B2C have a linear kind of a model. But I think in terms of say a business, for example, we currently own Mahindra Holidays, for example, and this stock has kind of seen a huge shave off in the last 6 to 9 months. It's off about a third from where it was. And that's because the perception is that, growth is still kind of maybe, 10-12% and things of that kind. But we clearly believe that this is an excellent franchise to own. And we clearly believe that there is tremendous potential here. So I think that's one kind of a case. The second case it's a call which we took a couple of years back, is Zydus Wellness. Okay. At that point of time, 2 years back, pharma was in favor. So a lot of people would ask us, why aren't you buying, the parent, Cadila Healthcare, and why are you buying the subsidiary, which is Zydus Wellness? And yes, we own Zydus Wellness, and it's been a fabulous kind of up move for the stock price. Over the last 2 years, not too many of the consumer staples have kind of doubled, but Zydus Wellness has kind of appreciated reasonably well because growth is back. They're talking of expanding beyond India. They're looking at even acquisitions in some of the interesting categories. So I think that's one more example where, when the business was down, but we were constructive. And I think over 2 years, that conviction seems to have paid off.
Give me an example or maybe two, where do you think there is a lot of hype and growth is not that? Markets periodically play this game.
Right.
When stock prices, they go higher, we always get attracted and drawn in with some hype analogy.
Sure.
Where do you think there is mispricing on the high side?
I think clearly some of the building material guys, I think there was a fair bit of hype about a year back. So the typical plywood guys, the tiles guys, the sanitary ware guys, all of these guys, they have been trading at very high PE multiples. Okay, and if you really look at it over 5 years, the revenue growth is not some fantastic. I mean, it's probably still low double digits or maybe even high single digits, not something more. Their margins expanded because gas prices were lower. Okay, which the street in a way factored in, saying that this is permanent margin expansion.
Great point.
Right? But gas prices are no longer high, and therefore if you see the last 2-3 quarters, okay, their margins have in a way peaked out. And I think clearly the market is not fully factoring in that. And the other thing, of course, is that the market was trying to factor in, saying because of GST, etc., this whole shift from unorganized to organized will happen, and these companies will be disproportionate beneficiaries. But I think somewhere we, in a way, mistake a small player to be an unorganized player. Every small player is not unorganized, and every large player is not organized. Okay, I think it can still be an unorganized player, even though it is large. So my sense is there is still a lot of hype. We think that this kind of a space, which is today seems to be very well celebrated, but our sense is that you're going to see some strong headwinds for this sector, and you could see even valuations and multiples come off.
Closing comments, and I'm just going to go back to when you started your career, one of the classic picks you had that time was Pantaloon, and the Indian retail sector in a sense has evolved. You got an Avenue Supermart, future good companies have made a roaring comeback. Trend is also sitting at a record high. Now globally we know there's a trend towards e-commerce, and that trend is disruptive. But in India the opposite is happening.
Yes.
Why is that?
That's because again I come back to my original discussion on how we Indians plan our vacations, and we still are kind of stuck to a bit of the conventional stuff. I think it's the same. I think in India buying, shopping is still a family experience. Yeah. It's not about just sitting back at home and going online and ordering something. We do that if it's something very standardized, but it's not something which is very standardized. Then we want to go out there, see it, feel it, and then kind of buy it. And therefore I think offline remains relevant in a market like India. I mean, offline is coming in a way a comeback in a market like the US, where Amazon is going and buying offline businesses, right? So it's not just about India. So if it's still relevant in an advanced or a developed market like the United States, I think it's even much more relevant in a market like India.
You know, taking a sabbatical and retiring early is the buzzword these days. So hypothetically, if you have to take a 3-year sabbatical, and if you want to retire before you turn 50, which are the 3 promoters or 3 businesses you would bet on?
That's a bit of a tough one, because it's really difficult.
I'm giving you advantage of time now, so that should be the easiest one for you, because the classic investor always wants more time. I'm giving you unlimited time right now.
No, so I think it would still be, so there's one business which is I think the healthcare business. I mean, I think that healthcare business has tremendous potential. A lot of the initiatives in recent times will really provide strong tailwinds to the sector. The sector is not today capital efficient. It requires a lot of capital. But I think if I'm on a sabbatical for 3 years, I would want to spend a lot of time trying to discover a company or a management which in a way has an asset-light model in this healthcare sector which has tremendous potential and promise. So that's clearly one sector. The second sector I think is the food sector, where if, for example, what has happened with rice over the last 15 years, okay, is there an opportunity like that in food over the next 10-15 years, where there is a large space or a large category which is still predominantly unorganized, and there's an ability of a management or a promoter to convert that from unbranded, unorganized to an organized and a branded play. I think that would be the second big opportunity out there. And third, I think, is basically in the capital equipment and the engineering space. I think, and even, add to that industrial automation.
You know, every time we interact, you come up with some classic, one-liners or acronyms. So this time I've done some work, and I've taken one from the Buffett's newsletter. And he says that if you want to be happy in life and a successful investor, avoid just 3 things: ladies, liquor, and leverage. Knowing your life, the fact that you're a dear friend, I'm sure liquor and ladies is not a challenge, but leverage. Rakesh Jhunjhunwala, when I met him last, he said, look, I understand leverage, and leverage has worked beautifully for me. Do you think for a classic investor, you should not shy away from taking leverage? When I say leverage, I'm not talking about satta. Right. I'm purely talking about better capital efficiency.
I think if you understand the opportunity which is there in front of you, and you are kind of more than 100% sure about it, then yes, I don't think there is any harm in taking leverage. But in general, it's something which I have shied away from. I both personally as well as when I've been investing in companies, I try and look out for companies which really don't have leverage. So I think there have been all situations which have worked and which have not worked. I mean, there are situations where leverage has worked, and there have been situations where leverage has not worked. So I don't think there's a binary answer to it. It all depends on your individual DNA, your individual style, your individual character.
Like one classic investor said, if you don't know what you are, stock market is a difficult place to learn. But we know what you are. You're a classic long-term investor who loves to hunt in the mid-cap space, and that is something I've always admired about you.
Thank you.
Appreciate your time, and thank you for joining us. With that,
thank you, Nikunj.
With that, it's time out on Market Makers. I'm glad we are back after a long break, but we've started with a bang with none other than Nilesh Shah. And I've always maintained that he's one of the smartest and one of the most vibrant stock pickers I've met in my career.